Good afternoon, everyone. Welcome to today's webinars. Today's topic is on options trading myths versus reality with the Montreal Exchange. I'd also like to note, and I'm sure you've noticed as well, that we are using a new webinar platform. It's called GoToWebinar, and hopefully it was easy for you to log in. If you have any questions or concerns, feel free to send them along to education@scotiaitrade.com, and we would be happy to help you out. So you should be able to hear us. I believe Jason and I did do a quick audio test earlier for those of you that did just join in shortly. If you are having some audio difficulties, you can click on that sound check link, the sound check link in the audio panel. And the setup window may show up on your secondary screen if you are using two monitors. As always, everyone is muted for sound quality purposes. And for those of you that have joined us by telephone to listen in, the PIN number is listed in the audio panel as well. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. You'll notice some new features, obviously, in GoToWebinar. So the arrow that you see right here, let me just use my markup tool. The arrow right here is a way for you to show or hide the control panel, and also if you want to make a full screen mode for the GoToWebinar platform, you may do so by clicking on that window icon, and the hand icon, the hand icon right there is if you have any questions or if you want to get our attention as well. My apologies, I don't think I did an audio test with the audience, so if you want to make use of this hand icon right there, just to let me know that you are able to hear me clearly, and I can move on after that or send you further directions. So if you can just please click on that the hand icon on the toolbar section of GoToWebinar, and that will confirm that you can hear me. Or you can also type in yes in the question box, as you see here as well. You can type in Y or yes. Okay, thank you, Sigmund. And let me just check the question box here if there's any yeses or nos. By the looks of it, it looks like Sigmund is the only one that can hear me. I have a feeling that you all can hear me as well, or I would have seen any questions or concerns in the question box. And again, feel free to let us know in that question box as well if you're having any issues. All right. So we are recording today's session, and if you did select yes on the registration page, we will email you that recording. Alternatively, you can access our past recordings on our webinars on demand page under the Learn and Do More section of scotiaitrade.com. You're also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. There is a handout panel that will show up at the end of the session, and you'll be able to click on that link. So I will make that available at the end of the session. And today's presentation is part of a learning series. So options myths versus realities, options trading myths versus realities is part of the series 1 series, Getting Started with Options. And if you haven't had a chance to view any of the past webinars, you may do so by viewing the webinar recordings under the Webinars on Demand, or sign up for future webinars on our webinar calendar. And our presenter today is Jason Ayers. He's been an instructor for the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He's a derivative market specialist by designation. Welcome, Jason, and I'm just going to share the other PowerPoint with you.
Hey there, thanks very much. Always a pleasure to join in, and looks like we are on the ball here with our technology, which is great. Looking forward to presenting what we were supposed to present last week. So hopefully folks that signed in last week were able to find the time to join us this week for sure. All right, so it looks like I now have the ability to begin the presentation, so I'm just going to go ahead and get started. We want to take a look at options trading myth versus reality. One of the challenges for novice options traders and investors is, of course, weeding through all of the information that is available online when it comes to trading and investing utilizing options. And a lot of different sort of myths and misconceptions have arisen over the years, which we want to try to put to rest here today. So as we move forward, of course, we always want to make sure that, once again, everybody understands that today's presentation is for information purposes only, and the options market, not unlike any market, any financial market, does carry with it some risks, and we really need to understand those risks before we integrate options into our live portfolios. So lots to talk about here today. The first component of the presentation is really going to just sort of evolve around general misconceptions. So the idea that options are risky. Of course, we just mentioned that options can be risky, but in general, we want to just sort of reference just where the risk lies in some of the option contracts and some of the considerations in that regard. We're going to take a look at the question as to whether or not put options are more risky than call options. We're going to talk about options as a zero-sum game, and we're also going to compare and contrast stock and index options as well. We're going to discuss option premium risks, so the question of whether or not low premium options should be purchased because they are cheap, and conversely, whether or not high premium options should be sold because they generate greater income. We'll also take a look at some of the myths surrounding profitability, with the idea that options are too expensive and that commissions and spreads on options are too excessive to make profits. We'll also address the idea as to whether or not, when you buy an option and the stock doesn't move, do you lose all your money? And finally touch on market makers and whether or not they're actually taking advantage of us as small investors. We'll wrap things up with a look at the covered call strategy and some considerations and myths and misconceptions surrounding that strategy, which is a very powerful strategy that we utilize with inside and outside of our registered accounts. So options as an alternative. Why are we looking at utilizing options as a complement to our investment approach? Well, the bottom line is that in this market environment, we really do need to consider all the tools available to us in order to gain an edge in the market. So we're looking for an alternative to that typical approach to portfolio management, which really usually surrounds, buying the stock, collecting some dividends, or investing in, some sort of a money management security or a mutual fund. We really need to look at all of the different tools available, so that we could be hedging and managing risk as effectively as possible, and we could also be enhancing our income as effectively as possible. So again, these are the integration of options offer a number of solutions that help us meet those different objectives. But if you're just starting out, you've probably heard a lot of sort of myths and being being exposed to a lot of misconceptions, simply because people that don't trade and understand options usually are the ones that are doing all the talking without necessarily having any idea what the market is all about. So when we consider where these myths and misconceptions come from, again, it all boils down to a lack of understanding. A proactive investor that takes the time to learn about the options market tend to be often discouraged by the misinformed. So again, you're at a dinner party, or you're at the gym, or you're playing around at golf, and you're talking to somebody that's maybe heard a little bit about options. There tends to be a move towards the discouragement. But time and time again, for those people that have decided to increase their knowledge and put these strategies to work, time and time again, it's proven otherwise, that there's absolutely value add in integrating options into a portfolio. So let's look at some of these misconceptions. You know, the first misconception or myth is that options add more risk. And really the reality behind that is that there are risks associated with options. There's no question about it. But that's true with all financial instruments. In reality, options can be used for trading a directional bias. We've talked about that in a number of our different presentations. Options can be used as protection, so creating an insurance policy around a particular stock or around a portfolio. And options can be used to generate income. And in fact, when you are utilizing options to generate income, such as the covered call strategy, you're actually offsetting some of the volatility associated with the price fluctuation up and down for a stock. So it's really not the option itself that adds the risk. It's the understanding of how to utilize that option that makes the difference in how much risk is being introduced to a portfolio. And each strategy has its own unique risk and reward profile. In fact, you know, if you happen to go online and you take a look at options risk reward profiles, there's some really great charts which reflect the risk associated with all the different strategies, and you'll see that really not one strategy is the same in that regard. There are some strategies with limited risk, there are some strategies with unlimited risk exposure, and you know, we need to make sure that we understand the difference between the two and also understand when it's appropriate to be utilizing these strategies. The other question that comes up, or the other myth, is that puts are more risky than calls. But in fact, puts are priced the exact same way as call options based on their potential, or the stock's potential, to move higher or lower. And so the amount of risk that is actually introduced into the strategy is in fact at the discretion of the investor and will depend on the strategy that is selected. So, you know, an example of that is a short call option. So if you sell a call option naked, so without the underlying security being present in the portfolio, that actually has a much greater risk exposure, in fact an unidentifiable risk exposure, than if you bought a long put. So again, we're utilizing a call option and we're selling it or writing it, and that has a significantly greater risk exposure than if we were to buy a put option. So again, just to reinforce the important consideration that risk is at the discretion of the investor, and you need to understand the risk associated with the strategy before you actually implement it. The idea of options being a zero-sum game means more risk. Well, what is a zero-sum game? Well, that's the theory that the gain of one market participant is equal to the loss of another. And that in fact is true in the options world. If as a call buyer I pay $1 for a call option, well then the writer receives that $1. When the call option expires, the buyer has lost that $1 and the option writer has gained it. So in theory, yes, the options market is a zero-sum game. But once again, recognize that investors and traders are going to be utilizing these strategies differently. And so, for example, if I buy a put option for protection, then I'm okay if that premium expires and I lose that entire amount, because what that means is that I didn't have to use my insurance policy, right? So again, we have to understand that this zero-sum market adding more risk to a portfolio is really, again, dependent upon how you're actually utilizing the strategy. So to sort of simplify it, it doesn't mean that there's a defined winner or loser. The covered call writer sells a call for income. They may be assigned and have to deliver the shares to the call buyer who wishes to own them. They both, in each case, have profitably accomplished their investment objectives, even though one side has essentially lost the premium associated with the option contract and the other has in fact gained. In reality, they both accomplished what it is that they set out to accomplish. The the difference between stock and index options is an important consideration, and a lot of people think that they're really one and the same. But we want to recognize that while the index option premiums are determined utilizing the same pricing variables, they actually differ in their contract specifications. So when it comes to the underlying asset by which the options are priced, when it comes to exercise and assignment, when it comes to settlement and trading units, each are actually different. So we're taking a look here at a typical stock or ETF option as a comparison to an SXO option, which is an option that trades on the S&P TSX 60 index. So when we're looking specifically at the underlying security for the stock option, of course, the underlying is the options eligible stock or exchange traded fund. But for the SXO index option, it's actually the entire S&P TSX 60 index. And so because a stock is priced differently than the index, we actually have to multiply the to determine the value of the contract differently. So with the stock option, one contract equals 100 shares. So we multiply the premium by 100. For the index option, in this case, we actually multiply the option contract by $10, which represents the or by each S&P TSX index point. Now, as far as exercise and assignment is concerned, very important difference. The stock option or ETF option is American style, which means that it's exercisable at any time. And just to build on that, if we take a look at the settlement are the actual shares of the underlying security. Right? When we look at the exercise and assignment process for SXO options, they're actually European style, which means they're exercisable only at expiration and they're cash settled in Canadian dollars. So these index options actually make for a really good tool when it comes to hedging a diversified portfolio, because you can create the hedge and not have to worry about delivering shares of the underlying security. If the overall market goes down and your portfolio suffers accordingly, well, instead of having to sell shares at the strike price selected for the ETF or stock option, you basically can settle your you can settle the position for cash, and ideally that cash addition to your portfolio will offset the loss that's been incurred in the underlying shares. Now, finally, also very important consideration is the last trading day. For options eligible stocks or exchange traded funds, the last trading day is in fact on the market close on the expiration Friday. But for the SXO options or index options, it's actually market close the day before the expiration Friday, so that would be the Thursday, because the options are settled based on the opening price of the index on the Friday morning versus the stock or ETF options, which are priced based on the underlying securities value at market close at the end of the Friday's trading date. Now, option premium myths. So there's always this sort of thought that a higher premium options should be sold because they generate greater income. And I've run into this time and time again as we're teaching aspiring investors on how to use options, is that they're always looking for expensive options to sell. But we have to recognize that option premiums account for all known information. So there's a reason why options may be considered relatively expensive comparative to other options within the market. The higher premium is in fact reflecting a certain degree of event risk or material stock volatility, which means that the higher the option contract premium, the higher the probability, at least in the eyes of the market, that the stock is going to move sufficiently enough for that contract to be in the money. So that is priced into it. So if you are doing the covered call strategy on a stock that you own, and you're getting some really good premium for those contracts, it's because the market believes that the stock that you're holding is going to be volatile, and that is what's being priced in to the actual contract. So, essentially option writers are getting paid to assume a higher probability of having to fulfill their obligation. Now, probability myths. We have to always recognize that that options are priced based on probability. And again, just to circle back to options being expensive, the reality again is that market makers price options according to all known information. So the reason why options may be considered relatively expensive is because the market is pricing in that a certain amount of volatility within the underlying stock, or a certain amount or a certain level of uncertainty, if I could use that term. And so, as an investor, you can be a buyer and or a seller. So there are strategies that in fact allow us to help offset the cost of an option contract. So if I look at the implied volatility associated with an option contract and it appears low relative to the market or to the stock, then I may want to be a buyer. But if it looks like the premium is high relative to that of the stock, I may actually want to find some sort of an option writing strategy to use, or I can implement a spread strategy that will help offset that the cost. So again, it's up to us to really determine what the most appropriate strategy is based on our observations in the option contracts that we're looking to trade. Now, this comes up on a regular basis, the idea of commissions and spreads on options being too excessive to make profits. In reality, we do absolutely always need to assess each situation independently. Certain thinly traded stocks have thinly traded options, and the more thinly traded or the less volume associated with the option contracts, the higher the spread, or the wider the spreads, which means that we may end up paying a little bit more. But if we build a portfolio of Canadian securities that are highly traded, then you find that the option contracts associated with most of those stocks tend to have quite reasonable spreads. And of course, commissions are really dependent upon the strategies that you're implementing as well. So, and how frequently you're implementing them. So, for example, if commissions on selling covered calls on a month-to-month basis on your stock is a little overwhelming, well, then instead of selling those calls monthly, you could sell those calls every 3 months or even every 6 months. Whatever works within your budget, so to speak, in terms of commissions being paid. So really, it's up to us to make those concessions to accommodate the commissions and spreads associated with utilizing options. And again, the impact of commissions, beyond just the amount of activity, is going to be dependent upon account size as well. So the next one that I want to look at is if I buy options and the stock doesn't move, I lose all my money. Well, the profitability of an option contract is going to be dependent on the strike price selected, right? So, the only way an option will have value on expiration is if it has an intrinsic value. And the intrinsic value of an option contract does not decay with time. So if you buy an option contract today that has intrinsic value, even though time may be passing by as we move towards that option's expiration date, we want to recognize that it will always be worth its intrinsic value. So as a result, you may not necessarily lose all your money. You will lose the time value component of that if you hold the position till expiration. But as long as that contract still holds an intrinsic value, well then the option contract will you'll be able to sell that contract for a value on expiration. Because only the time value component erodes over time. The the other important consideration is that as a as an option buyer or an option writer for that matter, you actually have the choice to close the position before expiration. So quite often an aspiring options trader will buy a call option, for example, because they think a stock's going to move higher, and it maybe does very quickly, but because there's 3 months until expiration, they feel that they have to hold the position for the remaining time, where you can actually close the position at any time, which means you don't actually have to hang on to it until expiration and suffer all the time premium decay. If you find that the stock is not moving as you anticipated, if you find that time is passing by and the stock is doing nothing, you can close that position out any time before expiration and ideally recoup as much of the premium as possible. A lot of misunderstanding around the market maker's role within the process. So the myth is that market makers control the direction of the market and seek to manipulate it to their benefit, when in fact it's actually the opposite. The market maker is actually there to ensure liquidity and to quote a two-sided market. So they actually have to be the buyer for every seller, and they have to be the seller for every buyer. So if, let's say, for example, we're entering into a bearish market environment and everybody wants to buy put options, well, that market maker actually has to be the seller of put options, which positions them in a little bit of a precarious situation in the event that the market does indeed sell off. So what they will look to do is they will look to hedge their risk exposure utilizing other option strategies or utilizing positions within the underlying security. But their main objective is actually to make money off the spreads between the bid and the ask. And in fact, that's actually, just to go back to what we were talking about earlier on in terms of option spreads, one of the reasons why we may see the spread between a bid and an ask price widen out is because the market maker is in a position where they've had to take the opposite side of a trade, and they're maybe having trouble hedging the risk utilizing other securities. So what they do instead is they try to compensate a little bit more for that risk by widening out those spreads. So it's kind of like your insurance broker. If you are a high risk driver, they're going to maybe up your premiums a little bit and expect a little bit more just because they're having to take that risk, that additional risk in writing that insurance contract. So again, market makers are there to provide liquidity. So what that means is if I buy a call option, I don't have to rely on the other investor who maybe sold me that call option as part of a covered call strategy. I don't have to rely on that other investor to want to close out their position. The other investor can maintain their covered call position, and quite simply, I will just sell my call option back to the market maker, and they'll look to offset it somehow or do something with it in order to facilitate the transaction. So we really don't have to worry about other investors and transacting business with them. That's what the job of the market maker is, and they're not out there to manipulate. They're out there to provide liquidity. And so just to give you a bit of an idea, again, we constantly talk about being able to, be on the opposite side or being able to be on either side of an option transaction, depending upon what it is that we're looking to accomplish. And as I said, the general consideration is, well, if I buy a call, I need to rely on the call seller to buy it back from me. But that's, again, absolutely not the case. These market makers take that out of the equation, which simply means that I only have to worry about my strategy. And that's really, at the end of the day, the point that I want to make here is that that market maker allows you to implement whatever strategy you feel appropriate and buy and sell as you feel appropriate, regardless of whether or not anybody else is doing the, is doing the opposite. So who are these market makers? Well, there are lots of market makers out there. Really, the market maker actually fulfills a specific role in that what they'll do is they accept the risk of holding a certain number of shares or contracts for an underlying security to facilitate the trading. So it's kind of like picture, the market maker as having a great big shopping cart full of stocks and options. And in some cases, they're putting things into the basket. In other cases, they're taking things out. But what they are doing is they're buying and selling out of that basket of securities in order to keep the markets flowing and moving and people transacting. So once the order is received, the market maker actually will attempt to, sell the position or buy the position into their own inventory, or they will actually go out to find somebody else at another firm to take the other side, or they'll just look to hedge. So they've got some decisions to make on their end once the order comes in. That's why sometimes you'll find that your order may not fill immediately. It's because these market makers are on the other side trying to find a way to accommodate that particular transaction. Pardon me. And it's interesting to note that there are, in a lot of cases, multiple firms making a market on a particular security. So what that means is that there's competition, which is important. So it forces the market makers who are in charge of pricing these option contracts. It actually forces them to be competitive, right? And that's good for us. The more competition amongst market makers, the more efficient and competitive the market is for us when it comes to pricing and execution. To sort of take a look at the general realities, as an investor, we're in control of our investment objectives, which means that has nothing to do with the market makers or the markets in general. It's about us really trying to determine what it is that we're trying to accomplish. We're actually in charge of our directional bias. Again, the market maker is not trying to dictate which direction we trade. That is completely up to us. Once we've determined that, we then will look to execute accordingly. Same with the strategy. Right? It's up to us to determine which strategy we're going to use to participate. The market maker does not determine that either. And then it's up to us to determine how we manage our risk and how much capital we allocate to the trade. So we have a lot of things that are within our control that have nothing to do with the market maker. The market maker is only there to facilitate the transaction once we have done our due diligence and determined our investment objectives, directional bias, which strategy, and ultimately, how we're going to manage our risk and how much capital we're looking to deploy for the strategy. So the last topic that I want to cover here for this presentation, and then of course we'll open it up to questions, are some myths surrounding covered call writing. There is a sort of a myth out there, and this doesn't just, this doesn't necessarily surround simply covered call writing, but that most options expire worthless. The reality is that it's directly dependent upon strike price selection. So to give you an example, out-of-the-money options have a higher probability of expiring worthless. We know this. I mean, that's the reason why they're priced lower than at the money or in the money options, quite simply because they have a higher probability of expiring. Now, the other thing, the point that I want to make is if we think of, for example, and I'm just going to use the SPY options in the U.S. The SPY is the ETF that tracks the S&P 500. That has 4,000 option contracts trading on it at any given time. So we want to recognize that there is always going to be a certain percent of options expiring worthless. There's no question about it. But the probability is dependent upon the characteristic of the option contract. So for example, an at-the-money option contract has in fact a 50% probability of having an intrinsic value on expiration, which means that it is not going to expire worthless. It would be exercised, or the person would be assigned because it has a value. Now, some statistics which are interesting, according to the CBOE, the Chicago Board Options Exchange, approximately 10% of options are exercised during the expiration cycle. So what does that mean? That means that an individual who has bought an option contract, a call option or a put option, and where that option contract has perhaps gone in the money, they will exercise and take on the and either buy the underlying shares or sell the underlying shares as part of that exercise process. So 10% of options are exercised during the expiration cycle. 60% of options are traded out of before expiration. So individuals that have bought or sold option contracts as part of their strategy don't actually ever 60% of them don't actually ever see it through to the expiration date. They're selling it to lock in a profit, or they're selling it to cut their losses, which means they're in fact managing their risk and not waiting for the options to expire. Now, of course, those options may very well expire, but the fact is they are not being held through to expiry by the trader or investor. And then finally, only about 30% of them ever actually expire worthless. So when you put it into that perspective, you'll recognize that there's reasons why there are many different reasons why options are being utilized, in certain cases you may want to hold until expiration, and you may want those options to expire worthless. In other circumstances, you may be closing the position out beforehand, which means regardless of what the percentage of options that expire really is, it's really about how you manage the position that counts. Now, as far as the idea of covered call writing underperforming, the profitability of the covered call strategy is a function of the market environment. So in a sort of a static market environment, option covered call writing can actually outperform the market and has historically done so. It'll also depend on the stock selection, what you're getting for your premiums, and also what strike prices you are writing, and it will also be dependent upon your risk management. So, covered call writing on a portfolio of stocks that are trending to the downside and losing value, security value or share value, is a consideration for risk management, not a consideration for the effectiveness of the strategy itself. The covered call strategy actually has outperformed, or would outperform over the last decade, because the market has returned very little to buy and hold investment. So that being said, if you're looking at buying a basket of securities that are reflective of sort of the broader markets, by adding the covered call writing strategy to that portfolio and strategically selecting which strike prices you're writing, you actually have the ability to outperform. The other consideration is the investor's search for yield and cash flow. One of the important considerations, I believe, moving forward in this current market environment is that we're now in an environment where you've got low to no interest being paid on securities. Very, very hard to find anything that's yielding any sort of a consistent cash flow. So understanding that value, the value of consistent cash flow that it can bring to a portfolio is a very important consideration, and something that we all need to look at moving forward, particularly if we are entering into our retirement stage, where we're more concerned about cash flow and managing volatility than we are about market upside. So the during certain periods, guys, just to sort of backtrack, when you're in a market environment where securities themselves are providing some substantial compound returns, and in fact, the last 8 years have not been too bad. But there is a challenge with, if you're always writing at the money calls, never being able to benefit from the appreciation of the underlying shares. So the performance or lack thereof, with the covered call strategy, as I mentioned, is going to be dependent upon what the market environment looks like. And if you think we're in a period where stocks, the stock upside is more attractive, then you sell further out of the money call options, give the stock room to move, and then subsequently take advantage of that while you're generating a conservative cash flow through the covered call strategy, right? Just something to consider. So, guys, it looks like we're in a position to wrap things up a little earlier than usual here, but I want to definitely give everybody an opportunity to type in their questions. So, Rose, I mean, if you want to sort of facilitate any questions that folks might have, I think we've got a lot of interesting information here to sort of formulate a good discussion over the next little bit. So if anybody has questions, just simply type them into the Q&A box. And Rose, if you want to jump back on and maybe sort of moderate any questions that are coming through, that would be fantastic. In the meantime, while Rose is jumping back online, just a reminder that there's lots of great content at the Montreal Exchange to be found, as well as these sessions being recorded and made available on the iTrade platform as well. So Rose, I'll pass it over to you.
Thanks, Jason. And as Jason mentioned, please type in your questions. I'll be doing the closing remarks to give you a chance to type in your questions in the Q&A box. And once I see them, I will address them and forward them to Jason. So next steps is you can access our webinar recordings on our website from next week on. And after you exit today's webinar session, a short survey will load in your web browser. So please fill that out so that we can better meet your needs. And don't forget to mark your calendars. Horizons ETFs joins us next Tuesday, August 9th at 1 p.m. Eastern Time to present on transitioning to an ETF portfolio. And Montreal Exchange is with us again on Tuesday, August 23rd at 1 p.m. Eastern Time to present on options as a hedging strategy. And you may sign up for other webinars on our seminar and webinar calendar under the Learn and Do More section of scotiaitrade.com. And also past webinars can be found on our webinars on demand page as well. And with that, I'd like to thank Jason for sharing his insights, and thank you all for joining us today. And I'm just going to check the question or the Q&A panel to see if anyone has typed in any questions as well. And I'll also be sharing the handout with you shortly. Let me just open that up. And the handout is loading, and you'll see that shortly. It should be, there you go. You should be able to download that, and if you're not able to, feel free to type it in the question, the Q&A box as well. Thanks, everyone, and have a great day. And if you think of any other questions after today's session, feel free to send them along to education@scotiaitrade.com, and we would be happy to forward that to Jason as well. Doesn't look like anyone has any questions for today. So thank you again, Jason, and thank you all for joining us.
Yeah, thanks, everybody. Have yourself a wonderful rest of the week.
Take care. Have a great day.